In that case, we'll get started. So last that I remember, we're talking about the I minus C taxation system, right? And there we talked about what? There we have talked about that how we see that I minus C is basically two things, right? Shareholder profit, and it is the other part of I minus C is basically shareholder plus
policyholder profits.
exactly. So shareholder profit plus policyholder profit, right? Totals to I minus E, right? Investment returns minus expenses. Right. Falguni, I remember you were not there in the last part of yesterday's class, right?
Yeah, sorry, I was traveling and I lost internet connection.
No worries. So what we are doing right now is we started looking at the different taxation systems, right? So like first we talked about something called a trading profit. Okay. So trading profit is nothing but your what do you call it? Premiums plus premiums minus claims minus expenses plus investment returns plus your what do you call changes in reserves. Changes in liabilities. Okay. So basically change in what we have a classic definition of profits in an insurance company, change in reserves, right? So change in assets minus change in liabilities. Your change in asset is nothing but your premiums plus investment returns minus expenses minus claims, right? That plus change in liabilities becomes your trading profit. Okay. The next thing that we like, that is one way of taxing an insurance company. That's fair. Okay.
Okay. Yeah.
So that's the first thing that we were talking about yesterday, is this one. So trading profits is premiums plus investment returns minus claims minus expenses minus increase in liabilities. Yeah. The second way that we talked about is, which is called the I minus E system, is basically where we do an investment return that includes a dividend income, unrealized incomes on equity properties. Subtract from it is from it the expenses, and you get the I minus E basis profit. So far, so good, guys. Yeah. Correct. Any questions there? Yeah. So what we did then was we tried to break this down I minus E into two parts. Okay. The first part was shareholder profit and policyholder profit. So when we broke down this I minus E equation, we saw that we can express it as basically both shareholder profit and policyholder profit together become I minus E. Okay. Does this make sense, guys? Yes or no? You all remember this? Yeah. So shareholder profit was nothing but the trading profit part that we talked about, right? And anything over and above that, like the gap of that and the gap between the trading profit and your I minus E profit simply becomes the policyholder profit, right? Now, since usually the profit taxation rate for profit of an corporate entity and that of an individual are different, right? For example, in India, if you think about a corporate entity, the taxation rate is a flat percentage, right? For individual, it's slapped at different rates, right? So because these rates are usually different across jurisdictions, these two profits, like the sources of profits, need to be distinct and distinctly identified, and the different rates should be applied to those different parts of the profit, right? Yesterday we discussed up until here. So any questions there, guys? All good?
I think this one, right, for proprietary companies, we still need to go through it, right? This one, the minimum profit test.
Yeah. We'll come to that. We'll come to the minimum profit test, right? We discussed up until here that we have something called a shareholder profit. We have something called a policyholder profit that we can split the I minus E into, and we need to find out the different parts of it because, again, we need to tax it at different rates, right? The taxable amount will be based on different rates for these different parts. Yeah.
And just to confirm, so shareholder profit you are saying is actually we can consider it as trading profit only?
Yeah, it's a trading profit. Yeah.
So if it is correct, is it correct to say that in I minus E basically we are paying extra tax in a way? Right?
True.
I minus is paid because we are paying shareholder profit, which is again trading profit plus policyholder profit.
Policyholder profit. Exactly. Yeah.
Okay.
So you're paying in a way you're paying tax on behalf of the policyholders, right? If you do this, the rate that is imposed on that part of the profit is also the policyholder, like individual tax rate, right?
Yeah.
So you're paying some tax on behalf of the policyholder, right? Which the policyholder would have eventually paid at the end of the contract. Yeah.
Right. But it does not make sense in a way, like if the basic profit is the non-zero number, okay, then it makes sense. But if basic profit is zero, right? It basically, can we say I minus E basis is same as trading profit?
True.
Right?
True.
Okay.
Agreed.
Okay.
Yeah. Cool. Now we come to the part that we're talking about, which is called a minimum profits test, right? Which usually gets applied for what do you call proprietary companies, right? Proprietary companies means companies that have some distinct shareholders, right? So it's usually applied for proprietary companies who are taxed under I minus E basis. Now, one thing to understand here is not all businesses will get taxed on an I minus B basis. Someone will have a trading profit basis. Someone will have an I minus E basis. Which company will get taxed on what basis? That we'll talk about in the next chapter. But the point is, this minimum profits test gets applied on proprietary companies who are taxed under an I minus E basis. Okay. Now, what does this mean? This means that the minimum taxable amount for an proprietary company who is taxed under an I minus E basis needs to be at least the trading profits. Okay. So if at any point of time it so becomes the case that your I minus E profit is lower than the trading profit, when can that be the case? When your, say, policyholder profit is what? Negative? Agreed? Yes or no, guys?
Yeah.
So if your policyholder profit is negative, your trading profits will be greater than the I minus E calculation, right? In that case, the minimum profit that will be taxed, the minimum taxable amount will become the trading profit. Make sense? Yes or no?
Policyholder profit, when you say negative, does that mean that premiums were greater than claims?
Exactly, premiums are greater than claims. That's policyholder profit being negative.
Okay, understand. Yeah.
Yeah, because what is policyholder profit? Policyholder profit is C minus P, right? If that is negative, then P is greater than C. Yeah. So whenever that is the case, which means that trading profit is greater than I minus E profit, right? Then the minimum profit test applies, and the insurance company will anyways have the taxable amount for the insurance company will become what? The entire trading profit. Okay. So far, so good, guys. Any questions?
Yeah.
Right. Now, it can also be the case that the trading profit itself is negative, right? Which means that there's a trading loss. Agreed? Then you will have to look at it on a net basis, right? After taking into consideration policyholder profit, what is the total amount, right? If that still becomes positive, you pay the profit on the net amount, right?
Yeah.
But what needs to be understood here is that you do not have a policyholder profit component if the minimum profit test bites, right? If your trading profit is greater than I minus E, there is no policyholder profit component. You just get taxed on the entire trading profit amount. Okay. So far, so good, guys. So if we were to walk through this process, you'd start off with what? Would start off with determining the trading profit, right? Trading profit is basically your minimum profit as well, that you have to at least be taxed on. Correct? Yes or no? Right? This entire profit is taxed on what? The taxable rate here is the corporate taxation rate. Agreed? Yeah. Now, this is the minimum tax that you're going to pay anyways. Now, the next thing that you look at is what is your I minus E, right? If this I minus E is greater than the trading profit you have determined, the balancing figure becomes policyholder profit. Correct? Yeah. And that balancing amount is taxed at the individual tax rate, right? the income tax rate, basic individual tax rate, income tax rate, right? If that I minus E is lower than the trading profit or the minimum profit you determine, there is no policyholder tax component. Make sense, guys? Any questions there?
One question. Shareholder profit, we have done like P plus I minus E minus C type. So at that point, I think we did not include increase in liabilities, and you said
so
that.
there we have said that the C that we have talked about includes increase in liabilities.
But
okay, so
but
we have not explicitly mentioned it, but increase in liabilities is also there.
Right. So
Yeah.
I thought that increase in liabilities will go under shareholder profit, or I think maybe loss, but it's just part of shareholder profit SP. But you are saying it's part of C, which is claims.
Yeah. No. It's so the point is the shareholder profit that we start off with, right? When we're talking about an I minus C basis, we assume that it includes any increase in liabilities as well.
Correct.
Right?
Correct. That's what I was saying. Yeah.
So the shareholder profits, when we're talking about say P minus C, it includes the increase in liabilities that we are subtracting.
Okay. So yeah, SP includes basically SP component includes increase in results.
Exactly. The shareholder part will include the increase in liabilities because that is the part of trading profits.
Right. Correct.
Okay. So far, so good, guys. So till now, what we have talked about, we have said that there is a case that it may be so possible that the policyholder profit is negative, right? In that case, what happens is I minus E becomes lower than something called trading profit or shareholder profit. But wherever this I minus E basis is applied for a proprietary company, the proprietary company needs to apply something called a minimum profits test, which gets kicked in if this case occurs. That is, if the shareholder profit or the trading profit is greater than your I minus E, or your policyholder profit is negative. And in such a case, the minimum taxable amount for an insurance company becomes the trading profits or the shareholder profit, which is nothing but your premiums minus claims plus investment returns minus expenses minus increase in liabilities. Okay. So far, so good. Any questions? This minimum profits test is clear to everyone? Yeah. Cool. The next thing that we need to talk about when it comes to the I minus E taxation system, it's about something called excess E. So often also abbreviated as the letters X, S, and E. Like a company is said to be in an excess E position when you can think the what do you call the company's minimum profit test bites, right? If the minimum profit test bites, it means the company was not able to take advantage of some expenses this year. Correct? Yeah? Yes or no?
Yeah.
Correct. There was some negative. So what I'm trying to say is, if the minimum profit test bites, right, there was some negative component in I minus E, which the company was not able to take benefit of it this year. For example, the shareholder profit was 100, policyholder profit was minus 20. The I minus E profit was 80, but it was still taxed on 100, right?
Correct. Yeah.
So it was not able to sort of take advantage of that extra 20 rupees of expenses somewhere. Correct? Yes or no?
Why are you saying it as expense minus 20? It's basically policyholder profit, right? So
I know it's
basically
policyholder
claims.
profit. Yeah, but at the end of the day, that minus 20 is coming from the I minus E portion, right? Because RHS is still I minus E. So I'm assuming this minus 20 is coming from some investment return netted off against expenses, right? So it is some some sort of expense for the insurance company, right? Because it is a negative amount, say.
Oh,
right?
Okay.
Yeah.
Net expense.
So it is just a simplistic way of putting it out that at the end of the day, that 100 plus minus 20 is I minus E, right? So if there is a negative part, it must be coming from expense. Correct? Yeah.
Right.
So what happens in such a case? So it was not able to take advantage of an expense this year because the minimum profit test bit, right? So what they can do is they can carry forward this extra expense to the next year, right? In case the profit test does not bite in the next year, they can take advantage of that extra E the next year. Does that make sense? Yes or no, guys?
So if does not bite, they can carry forward. Carry forward what in this case? Like
They
it
will
was
not carry
20,
forward
right?
anything. They'll not carry forward anything. If, say, for example, the shareholder profit was 100, policyholder profit was 20, they have to pay tax on the entire 120,
Oh,
right? But in case they had some expense that was carried over from the previous year, they could use it to set it off, right?
okay.
Does that make sense? Yes or no? Tell me. So what I'm saying is, if in the previous year, for example, they had an excess E scenario, which means that they were not able to take advantage of an E in the previous year because the minimum profit test did bite. So what they can do? They would have carry forwarded that E amount to the next year, that is to this year. Agreed?
Agreed. Yeah.
Right? So they can take advantage of that excess E. For example, the last year's excess E was say minus 10. So they have a policyholder profit this year that is as much as 30. So they can net that minus 10 against this 30 and only pay profit on the 20 portion. Okay? Got it? Yeah. So that is what we mean by excess E, right? Now, why do you think that company will enter into an excess E scenario? Why even there would be some excess E? Let's try to think about the components of excess E. It's I minus E, right? So if there's a very low I, there's a very high E because of some reason, right? Because say the investment returns are much lower. They are, say, even negative investment returns, right? Or there is very high expenses because one-off expenses because of some reason, right? Or the minimum profit is very high. Say the liabilities increased by a lot amount, say because of some assumption strengthening exercise, right? So your minimum profit increased by a lot, because of which the minimum profit test did bite, right? So because of all these reasons, it may so be possible that your company got into an excess E scenario. Okay.
The expenses are higher than investment income. That's what you're
Yeah.
saying.
Yeah. Say, for example, the company is quite new, right? So the level of income would be largely low, right? But they will have a very large expenditure, right?
Right.
Or you carried out some sort of assumptions weakening. So your increase in liabilities has gone down. If your increase in liabilities has gone down, your trading profit has gone up. Your trading profit has gone up, the minimum profit test may bite, right? Yeah. So because of these reasons, what may happen is you may reach an excess E scenario. I think I missaid this previously, right? It is usually in an assumption weakening scenario that will lead to a large trading profit and thus to an excess E scenario. Right?
And the excess E is basically the negative policyholder profit from the previous year, right?
Correct. So that excess E amount will get carried forwarded year on year.
Okay.
Yeah.
So is it like, say, this will be useful for a small company, is it, where it is set up, its expenses are quite higher than investment income. As it goes forward, it can like spread that expenses across
True.
multiple years.
Multiple years. Yeah.
Rather than paying it in one go, so their tax liability is less. So it's in a way beneficial for small companies, is it?
Right. Exactly. Precisely
Are you
that.
presenting, like, is it like proprietary versus mutual companies? There is
Yeah, that one.
excesses.
Yeah, so like we've tried to cover this in a single line here. The next part is
Okay.
proprietary versus mutual. Yeah. So far, so good, guys. Any questions? All good. So that is what they've written here. Like, why may someone reach a temporary excessive position, right? You may be a newly established company, right? You may be weakening your liability valuation basis. There may be a significant fall in some investment return, in investment that you had made. So that leads to a negative investment return, right? So all of these lead to an excess E basis, right? Now, for a mutual company and for a proprietary company, these two usually mean different things, right? For a proprietary company, you have something called a shareholder profit and a policyholder profit, right? For a mutual company, everything is policyholder profit or everything's shareholder profit. Agreed? Yeah.
Right.
So for a mutual company, you have excess E only when I is less than E, right? But for a proprietary company, it can also be when your minimum profit test bites, right? It may be so possible that I is greater than E, but still the policyholder part of the profit is negative. Does a
Mhm.
comparison make sense?
Yeah.
Yeah.
So
Yeah.
basically, for mutual, I minus E is only equal to shareholder. Oh, sorry,
Exactly.
policyholder.
You may call it shareholder, policyholder, whatever you may like. It's usually policyholders, right? Because policyholders are the owners of the company.
Yeah. Okay.
I won't say call the owners of the company, but they are like credited all the profits of the company itself.
This
Okay.
material weakening of liability valuation basis, I do not understand how it will
Okay.
increase
Sure.
excess.
So what happens is, if, for example, let's talk about a proprietary company. Okay. What is your profit? Your profit is shareholder profit plus policyholder profit. That is equals to I minus E. Correct? Yeah.
Mm-hmm.
So when does the minimum profit test bite? When shareholder profit is greater than I minus E. Correct?
Correct. Yeah.
Right. Now, so what I want is something leads to shareholder profit. Some like factor leads to the shareholder profit increasing by a large amount. Right. That can lead to
Mm-hmm.
shareholder profit being greater than I minus E. Exactly. Yeah.
Mm-hmm.
Right. Now, what is one of those triggers? One of those triggers is one of the components of shareholder profit is increase in liabilities, right? You subtract increase in liabilities, right? So if your liabilities fall down, your shareholder profit increases.
Right. Right.
When
Right.
will liabilities increase? When you carry out a material weakening of your liability valuation. So you reduce your mortality rates, right, for a term
Mm.
product. That will reduce your liabilities, increasing shareholder profits. Shareholder profit increases, minimum profit test can bite.
Right. Yeah. So basically, you are saying uh, this we are releasing reserves, right?
Yeah,
Out
you're
of the
releasing
loss to
reserves.
shareholder.
Exactly.
To shareholder.
Exactly.
Okay. Okay.
Yeah. All good, guys. Does this make sense?
Yeah.
Cool. They've talked about one more very quick thing here, where they are talking about premium-based taxation, which means that like for an insurance company, and this is premium-based taxation for an insurance company, which basically means that instead of calculating, so like insurance companies can simply be taxed on premium income, right? So you look at the total premium income, you put a like percentage on it, right? That becomes your uh, like tax payable in a way, right? One of the pros of this is you can think about it, it's very simple to calculate, right? It's very easy to calculate. You don't need complex systems, complex calculations to calculate this, right? Very simple to understand as well. So very simple to implement. But the key disadvantage is what? For life insurance, you will often have what? Very high premiums, right? And
Mm-hmm.
like taxing based on premium income may not be as like beneficial from the point, may not be as attractive for an insurance company, right? Especially for say long-term products. For short-term products, it's a year-on-year product, right? It's yearly renewable. Still, you can justify it, right? But for something that's 10 years, 20 years old, where it's very difficult to look at how profit has actually emerged, right? The profit emergence pattern may not be similar to how premium payment pattern is, right? In that case, like premium-based taxation may not be as appropriate. Does that make sense?
Why are you comparing profit emergence with tax? Are you trying to say like if there's no profit, why somebody should pay tax? It's actually a
Not
loss.
just that. So the point is you should pay taxes when you have a profit, right? Now, profit emergence for a policy, especially for a long-term life policy, that pattern may not be very similar to how premiums are paid, right? Premiums, say it's a level premium policy. You are paying 1,000 rupees every year towards a term policy. But the profit emergence for a policy insurance company for that particular policy may be very different. It may not be level. Correct.
Right.
You will usually have very low profits in the initial years because you have initial expenses that are very high, right? Then you will start earning some profits, right? You will earn more and more profits in the starting years, right? Then towards the later years for a term policy, it will dip, right? Because at that point of time, the cost of providing mortality services increases as compared to the premiums, especially for a level term product, right?
Correct.
So
yeah.
the profit emergence pattern will not be very similar to premium patterns. That is one. The second one is obviously that you may not be earning a profit at all, right? It may be an onerous business, and premium-based taxation will lead you to paying taxes when you actually don't have any profits being made. Yeah, makes sense.
But, okay, it makes sense with profit emergence. I understand, but that can happen for like higher premium business. It says we can have it for like low ticket size premiums as well, right? The same concept. You don't know when profit will emerge. But
but we are saying for not for low ticket size. We are saying for short term businesses it may be useful. For say health businesses, which is say you renew every year. Right. So for
okay. So
short term businesses,
reviewable premiums versus okay.
Yeah.
So then, but more onerous for higher premium. What is so new about higher premium that it is onerous?
Because when you are expressing things as a percentage of premium, right? If you have a higher premium, the tax also increases, right? Right. So your tax liability may increase when actually you're not making as much profit, right? You may just have a higher premium, but your actual profit that you're making is quite low. Say it's very similar to a low premium business as well.
Okay.
Right? Premium-based taxation is usually what? You're just taking a percentage, put it on the total premium. Right? So higher premium businesses, which are not, say, earning as much in terms of profit margins, it may not be as suitable. Okay.
I still don't understand it. Okay, but
what you're saying is
like it can happen to low ticket size as well, right? Even though
it can happen to low ticket size. Exactly, it can happen to low ticket size. But for example, let's compare a couple of policies, right? 100 premium policy and 1,000 premium policy. The profit margins are different, right? In both the cases, the tax rate is flat 10%. Say you're paying 10 rupees in the first policy, 100 rupees in the second policy, right? But the profit margins must be such, right? In the lower premium policy, say you're earning 50 rupees, but in the second one, you're not earning 500 rupees. You're earning, say, only 100 rupees. Right?
Oh, okay.
Right? So, but again, taxes are expressed as a percentage of premiums. So it becomes more onerous for a higher premium business. That's what they're trying to say.
Okay. I think so. Basically, it's saying it's flat premium rate, but sometimes the profits are like diminishing. Like for a higher premium, it's diminishing. You can't have like $1 million premiums.
Yeah.
And
you keep increasing premiums, you essentially don't increase profits, right? In the same scale.
So the concept of that diminishing marginal rate.
Diminishing marginal returns. Exactly. Yeah.
Okay. I get it now.
Okay. Cool. So far, so good, guys. So this was the first chapter for taxation. We'll quickly move to the second one as well, where we'll now focus on what the UK taxation framework is in the first part of the chapter. We'll then talk a bit about Ireland, Australia, US as well. Again, you don't like for the UK taxation framework, you need to know what this BLAGAB, non-BLAGAB, all of this is. For Australia, South Africa, you just need to know on a high level, like they have something different and what are the high level principles, right? They have actually not tested you about any, like when it comes to IFoA exams, they've even for IA exams, they have not tested us when it comes to tell us what happens in Australia as a taxation regime, right? They they'll ask you to apply concepts from, they may ask you to apply concepts from there, but they don't ask you questions like that. Make sense? Okay. Should we start with this then? Yeah. So we talked about two bases, right? We talked about an I minus E system of taxation. We talked about a trading profit basis of taxation, right? Now in the UK, these two methods are primarily used for life insurance taxation. The way of determining what business gets taxed on what basis is basically this. What happens in the UK is that you try to classify all the life insurance business into these two categories. The first one is called BLAGAB, which is basic life insurance and general annuity business. And everything that is not BLAGAB is basically non-BLAGAB, right? So what happens in BLAGAB is you have your savings product, right? You have some general annuities, which does not have a pension component, right? And very old protection business. I think protection business that's before January 2013, right? Everything else becomes non-BLAGAB. So all your pension products, income protection, any overseas product, even your normal protection business, after any protection business sold after January 2013, all of that becomes non-BLAGAB. Okay. Now, what do you think? What kind of business gets taxed on an I minus E basis? What will get taxed on a trading profit basis? What category do you think is I minus E more suitable for?
I think I minus E is more suitable for BLAGAB, and
Exactly, because it has
and the trading profit will be for non-BLAGAB, right?
Correct, because the BLAGAB business is primarily savings business, right? You have got savings, life insurance, savings products, right? You have got non-pension annuity products, right? So all these are basically what? These are primarily savings products, correct? Yeah. So that is where you have a very significant investment return component, right? Where you have a roll up of investment returns throughout the term of the contract that will be paid to the policyholder at some point of time in the future, right? That is where you are using the I minus E basis. You are bringing into account the investment returns, correct? But when it comes to the non-BLAGAB basis, investment returns is not a significant portion, right, of your profits. It's mainly things like, say, like how your liabilities are changing because of mortality or say the expense experience over time, right? And that is where the trading profit method is used primarily for non-BLAGAB business. Make sense, guys? Yes or no?
Yeah. What is so different about protection business before 1st of January 2013 that it is under BLAGAB?
So what happens is they realize because of not something, but earlier what happened was protection business was included under BLAGAB. Okay. So it was only after 2013 that protection business was moved from an I minus E basis to a like what you call the trading profit basis. They realized that trading profit is more suitable for protection business. The reason being, what used to happen back then was, now, for example, take the example of an insurance company that's selling both savings business as well as protection business versus another insurance company that's only selling protection business. Okay. Other two examples, right? So for the first company, what will happen is you will have some sort of policyholder profit. You would have some sort of shareholder profit. But usually what happens for like on an aggregate basis, what will happen is the protection business would usually have a what? Excess E, right? Your claims will be less than the premiums, right? Agreed, guys? Yes or no? For protection business, your policyholder profit usually would be negative, right?
At the start of the period, not
Throughout the
end of the
period,
period.
like at the very end, you may argue yes, but on a overall, like if you think about the entire contract, not just about like a certain like
Okay.
term, right? On an overall basis, C will be greater than like less than P, right? So there will be policyholder loss,
Right.
correct? But
Mhm.
for a savings business, you will always have a policyholder profit because they will have a greater claim maturity benefit than the total amount of premiums they have paid. Agreed?
Agreed.
Yeah.
Yeah.
Yeah. For a savings business, you have a greater maturity amount as compared to the premiums paid, right? But if like in the case of a protection business, what you have is you have sold a profitable product, so your claims are lower than your premiums, right? So what happens is this company one, which is selling both protection business as well as savings business, and both are getting taxed on an I minus E basis. They were able to set off the negative profits from the what you call protection business with the positive policyholder profit from the savings business, right? So say the protection business has a negative policyholder profit of 20, right? And savings had a positive profit of 40. So they were say 50. So they only had to pay the policyholder tax on 30. Yes or no? Agreed?
Right.
Yeah. Now let's see how this compares with a case where an insurance company is only dealing in protection business. If it is only dealing in protection business, it now has an excess E condition because shareholder profit is positive, assuming it's a profitable product, but your policyholder profit is negative.
Mhm.
Correct? Minimum profit test bites. So it is not able to take advantage of that minus 20. That minus 20 is getting carried forward year on year. But say you have a very high excess E account, but you are not able to take advantage of it,
Mm. Mm.
right? Because you are always having a policyholder loss, right? So it becomes unfair to an insurance company who's only selling protection business, right, compared to an insurance company that is selling both protection and savings business,
Right. Right.
right? So that is at that point of time they realize, okay, does not set a level playing field. So they transferred term business to non-BLAGAB, and they said all protection business that will be sold January 2030 onwards will be taxed under the trading profit basis.
Mm.
Does this make sense? Like this is one of the classic questions that they had asked, I think 3 or 4 years back. So Samarth, Falguni, like clear to everyone, like why they may have chosen to put term business under non-BLAGAB instead of BLAGAB onwards 2013.
Yeah.
Yeah.
Makes
Clear.
sense.
Yeah.
Yeah, understood.
Cool. So that's about the taxation framework from the point of an insurance company. When it comes to policyholder taxation, again, it depends on the sort of product that we're talking about, right? When it comes to term assurance as well as savings product, you usually don't have any like tax relief on premiums. So you're paying premiums from your post-tax earnings, right? But your benefits are not taxed, right? So when it comes to term assurances, critical illness policies, right? Um, all of these are paid from a post-tax earnings, but benefits are not taxed. When it comes to savings products, again, you are paying premiums for your post-tax earnings, right? The investment earnings, right? Like we talked about, when it comes to a savings product, what basis are we talking about? I minus E or a what do you call trading profit basis? Tell me, guys. Tell me.
Sorry, can you ask again?
So what I'm talking about is we talked first considering term assurance and CI. Term assurance, CI, premiums you are paying from your post-tax earnings, benefits are not taxed. That is clear, right? Any sir? The next one is what? The next one is savings products. Savings products usually don't have any relief on premiums. You are again paying out of your post-tax earnings. So far, so good. Yeah.
Yeah.
What are the other ways in which you can be taxed? You can be taxed on a investment earnings. You can be taxed on the final benefit you are receiving. Correct?
Perfect. Yeah.
Right. Now, how are investment earnings taxed for a savings product? Well, remember, we have talked about the I minus E basis, where the policyholder profits are already being taxed, right? When the insurance company is paying their taxes year on year. Correct?
Yeah.
Yeah. So year on year, whenever the insurance company is paying taxes, right, they are already paying taxes on the investment earnings that the policyholders are earning. But this is paid on the what? The basic income tax rate, which in UK at the moment is 20%. So that means they are already paying the basic income tax rate. Agreed?
Yeah.
Yeah. Now what happens? At the point of maturity, they may have to pay the marginal income tax rate minus the basic income tax rate, something that we were discussing yesterday as well, right? The insurance company only deducts taxes on the basic income tax rate, say 20%. But if today I am a policy holder who lies in the 30% income bracket, I'll have to pay that extra 10% at the point of maturity. Okay?
Right.
Any questions, guys? So far, so good? Okay?
Yeah.
Cool.
Yeah.
Talking about general annuities, your annuities business, right? You have what are annuities, right? You have a corpus, you invest that somewhere, and you get lifelong income, right? So your premiums are usually post-tax, right? Because you have accumulated that money across number of years. So usually those are post-tax earnings. So again, you don't have any tax relief as such on your annuities. Annuities, if you all remember, are a part of what? BLAGAB or non-BLAGAB? They are a part of BLAGAB.
Right. Yeah.
Right, exactly. So it's very similar to how savings products work, right? Like savings, you're like whatever is the investment return roll up within the insurance company that is getting taxed at a basic income tax rate. Anything on it's so you're already being taxed on that earnings in a way when the insurance company is paying those taxes. Yeah. So far, so good, guys. Yeah. When it comes to the actual benefit payment, right? We need to see what is the for a savings product, it is very easy to see the profit portion, right? Take the sum of premiums paid, take the benefit, subtract the two, the profit, that is what will be taxed at the marginal rate minus the basic rate. Correct? Yeah. Agreed?
Yeah.
That was for savings policies. But for annuities, it becomes slightly difficult to understand that, right? Because in annuities, they are paying you, say, 120 rupees every month, right? 120 pounds every month. So you need to understand what portion of it is the capital repayment, right? Because you have paid a certain lump sum at the beginning, right? So what portion of it is the lump sum, like the capital repayment portion, and what is the, say, income or the interest portion of that? Correct? So whatever is the interest portion of that or the income portion of that, only that will get taxed at your income tax rate. Does that make sense, please?
Are you saying 120 pounds per month, you basically divide it into like dividend income and capital gains, and dividend income is
not dividend. The part of, say, you paid 100,000 rupees at the very beginning, 100,000 pounds, right? The insurance company is giving you back by paying, say, 200 pounds every month. Okay. Now, part of the 200 pounds is repayment of the initial 100,000 you gave to the insurance company.
Right.
And some part of it is interest payment. Correct. you can think of it as a loan, right?
Right.
So that
Right.
principal repayment, the capital repayment does not attract any income tax.
Oh,
It is
okay.
the remaining portion, the interest portion, that attracts income tax.
Right.
Okay.
Right.
Now, how do you get this portion? Like, it is very difficult to get that, right? Now, for example, someone is aged 55. You will look at average life expectancy. Average life expectancy is say 20 years, right? So 20 years is 240 months. The total, say, like initial capital that you paid for 240,000. So that means 10,000 every month is your capital payment portion, or £1,000 every month is your whatever is paid in excess of £1,000, that becomes the interest portion.
Right.
Okay.
So you divide it linearly, is it? Like per
You
month?
divide it linearly, exactly. Okay.
And whatever is above that is your interest payment. Like you
It's
earn
taxable.
interest.
Exactly.
Okay. Yeah.
Does that make sense, guys? So far, so good.
Yeah. Sorry, I have a few questions on the top. Like if you go in the non-BLAGAB section, there was something called overseas fraud tax, right?
Overseas
and
fraud.
risk.
For example, if there's an insurance company operating in the UK, but they are selling products in, say, Germany, right? So that becomes a part of non-BLAGAB.
Okay. I see. And this why it's very difficult to understand. On the left side is annuity, which I agree, general annuities, but on the pension side, pensions is basically an annuity, but it basically says it goes till lifetime, right? So why is
Not
it
just that, pensions usually has an accumulation phase as well.
Oh, right.
Right.
But,
so if you have a general
here
annuity,
also general annuity, are we saying it's only immediate annuity? It's not deferred annuity because
it may be a deferred annuity, but in pensions you have what? Regular contributions, right? Say someone age 35 year, 40-year-old can buy a pension product. They'll pay regular premiums for the next 15 years, and at 55 an annuity will start. That is a typical pension product. Deferred annuities, you pay a lump sum today. 1 year from now, you start getting this much rupees every year.
But the lump sum today, won't you consider that lump sum today as an accumulation phase as well?
You can, right? So that is what you'll have to see the proper there must be some rules as to what qualifies as a pension product, right? A pension product must require minimum amount of, say, regular contributions, a minimum amount of accumulation phase, right? Say if it has a 5-year period, that becomes a deferred annuity. If it's greater than 5 years, it becomes a pension product. Minimum number of contributions, they should be spread across different years, right? So only then things may qualify as a pension.
Right. Okay. Understand.
Okay. Cool. The next part is pension products, which is sort of non-BLAGAB policy holder taxation for products that are non-BLAGAB. How is they are taxed for pensions, especially for the UK? There's usually a tax relief on premiums, which means that they are paid from a pre-tax earned salary. So they have something we call that they are exempt on contributions, right? Something that we have in India as well. Contributions that we make towards PPF may really receive tax relief under the old tax regime, right? So, however, there are limits to it. For example, in the UK, if I'm not wrong, it's £40,000 per year, right? That is the limit for receiving tax relief on premium. So anything above that will be paid on your taxable, post-tax earnings. Make sense? Cool. The next is investment earnings. Investment earnings here are tax-free. That's why it is a part of non-BLAGAB. So when you are basically saving towards a retirement through a pensions fund, your investment earnings are rolled up on a gross roll-up approach. Remember we talked about it yesterday, gross roll-up approach, where you don't have where you're not taxing your investment returns as such. That becomes your gross roll-up approach. What about the benefits? So again here, this is something that was recently changed 5-6 years back, if I'm not wrong. They said that 25 of the benefits you can withdraw lump sum tax free. Okay, so say you have accumulated say a couple of millions in your retirement fund, 25% of the that is 500,000 pounds. 500,000 pounds you can withdraw tax free out of your retirement corpus, right? But everything else you need to convert it into pension payments. If you withdraw anything more than that as lump sum at the point of retirement, that will be taxed at whatever is your marginal rate of tax. Does that make sense?
So 25% of benefits basically implies you take 25% as a lump sum, and whatever is remaining will be taxed, right? First 25% lump sum is non-taxed.
Exactly. First 25% lump sum you can withdraw without any like taxes. Okay. The remaining gets converted into an annuity. Whenever you receive the benefits of the annuity, again you will get taxed at your marginal income tax rate return, right? If at the beginning you withdraw anything that is greater than 25%, that will also get taxed at your marginal rate of income tax.
Right.
Yeah. Okay. Now there's this concept of something called a lifetime allowance as well. What is lifetime allowance? Lifetime allowance usually means that, which means that what happens is you can only accumulate money in your pension fund up to a certain limit tax free, and that lifetime allowance right now for the UK is 1.073 million, right? So anything that you like accumulate in your pension once in excess of these allowances, right? Whether you convert it into an annuity, whether you like take it as cash, your tax your marginal tax rate of the highest income band will be applied here. Does that make sense?
Yeah.
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 Perfect. The next one is your BLAGAB, like how is insurance companies taxed, right? So we talked about, you split it out. We talked about BLAGAB, non-BLAGAB, right? So what is important here is to split out the BLAGAB fund, the non-BLAGAB fund, right? For example, the same insurance company may be selling trading business that is non-BLAGAB and BLAGAB, right? So they must split out these BLAGAB funds and the non-BLAGAB funds, right? So they must prepare separate accounts, right? So they can for say savings products, they can perform an I minus E calculation, they can perform the minimum profits test, they can look at what is the shareholder tax being taxed at a corporate taxation rate and the policyholder profit being taxed at a basic income tax rate, right? For a non-BLAGAB basis, it is usually as simple as any trading company. You can look at any accounts being prepared according to say IFRS 17 or the US UK GAAP, right? And according to that, the taxation takes place. Does that make sense, guys? Any questions there? All good?
Yeah.
Yeah. Now, Ireland has a taxation system that's very similar. Like they've considered a few more legislations. They've talked about Ireland, they've talked about the US, they've talked about South Africa, and if I'm not wrong, they've talked about Australia, China, Australia and China as well, right? So they've talked about these different countries as to how policyholder taxation and life insurance taxation looks there. So Ireland taxation is very similar to the UK taxation. So here, instead of like calling it BLAGAB and non-BLAGAB, they've called it old basis business and new basis business. Okay, old basis business is all business written before January 2001 that receives BLAGAB treatment, and all business that is written on or after 1st January 2001 that is taxed on the non-BLAGAB basis. So trading profit for all business after 2001 and I minus E basis for all business written before 2001. Okay. Yeah. So new business everything after 2001 you have on a gross roll-up basis, right? For example, if you have non-pension benefits, right, they are taxed at something, they call it the life assurance exit tax rate. So they have a separate tax rate that is the chargeable amount is whatever the gain the policyholder has made with that policy. That is simply the benefit minus total premiums paid, right? That just like say the capital gains tax, right, or the income tax rate, they have something called a life assurance exit tax rate, right? That tax rate is then applied on that profit portion. Okay, does that make sense, guys? Yeah, all your pension benefits, they are still taxed at your normal income tax rate, right? That is not taxed at this LAET, which they call it the life assurance exit test. And old business, you have like something that's very similar to your the BLAGAB calculation that we have in the UK. So your investment returns are rolled up on a net basis, but anything in excess of that, you have to pay the marginal return there, your marginal tax rate there. Okay.
Sorry, can you go up? It says here non-pension benefits in excess of premiums tax rate, life insurance exit tax rate. Can you just tell me again? Sorry, what?
So for savings product, we are saying in savings product, say in the UK, what happens is you're rolling it up on a net basis, right? Correct.
Rolling it up on a net basis means like tax-free, right?
No, gross is tax-free. In the I-C basis, you are still taxing the investment returns, correct? So you are rolling it up on a net basis, right? However, what happens is, so you're taxing the policyholder's income, investment returns year on year. But in Ireland, anything that is sold after 2001, it becomes new business basis. So you have non-BLAGAB. So your roll-up is on a gross basis, correct?
Mm-hmm.
Yeah. So what happens is at the end of the term, whatever is the total profit made. What is the total profit made? Total profit is simply benefit minus sum of premiums, correct?
Mm-hmm. Mm-hmm.
So that amount is determined. At that amount, the tax rate that is applied on that is called a life assurance exit tax rate. So like we, for example, have the LTCG rate, STCG rate in India. In Ireland, they have a separate rate called the life assurance exit tax rate. That is applied for the savings policies.
Okay. But here, like this old basis and the new basis is basically before 2001 and after 2001.
Exactly. It's not like BLAGAB, non-BLAGAB distinction. It is just how the taxation of old business is similar to how BLAGAB business is taxed in UK. The new business, new basis business is taxed similar to UK non-BLAGAB. So trading profit for everything after 2001, I minus E for everything before 2001.
Okay. Understood.
Cool. That's about Ireland. When we move to the US, right? In the US, what you have that your benefits usually accumulate on a gross roll-up basis, right? So you don't have the I minus E tanta there as well. You have a normal gross roll-up basis, right? Your death benefits are usually not taxable, right? But if you have a surrender benefit, withdrawal benefit, cash benefit payable, right? Any amount that is received, like any income that is received over the total premiums you have paid, that is getting taxed in some manner, right?
Mm-hmm.
Does that make sense? Yeah. You would have heard about something called a 401k, right? Which is basically the retirement pension savings plan for the US, right? There, the contributions are made from your pre-tax earnings. So you have a tax relief there. However, the benefits that you receive are taxable like your income. Okay. So just like UK pensions, right? UK as well, you have your exemptions, your contributions are exempt. Your roll-up is exempt from, like your investment return roll-up is made on a gross basis, right? But your proceeds, like your pension amount, the income amount is taxed, right? So US is very similar to that for UK, similar to UK pensions in that manner, right? When it comes to corporate taxation, like the calculation is usually based on trading profits, right? And you have a corporate taxation rate. However, there's also a premium tax payable. So a tax is also determined on the total premium you have paid. However, this rate is different for different legislations. Different for different US states. Now, the problem with US is you have 50 states. Every state has a different tax code, right? You so like they have different ways of like different premium tax rates. So you'll have to see which state the insurer is domiciled in. Whatever is the home state of the insurance company, it will have to collect premium tax rates based on the tax rates of that particular state. Okay?
Mm-hmm.
Right? Does that make sense, guys? However, if they are selling in some other state, then the higher rate will be applicable. For example, they are domiciled in California, they are selling in, say, Washington, D.C., right? So if Washington, D.C. has a higher premium tax rate, they will apply a premium tax rate that is applicable for Washington, D.C. Okay?
Sorry, just
For
to
South,
clarify, this gross roll up, whenever we talk about this gross roll up, it implies basically no tax, right? No tax.
investment on
and
investment returns.
no tax on investment returns. But whenever we say net roll up, it implies that there is tax on investment.
Tax on an I-C basis. Correct.
Okay.
Yeah. For South Africa, you again have gross roll up, right? Your life insurance assurance benefits are not taxable. You don't have any tax relief on premiums, right? Your pension funds are partially taxed, right? Then, like similar to the UK, you have a partial like amount to which you can withdraw as lump sum without any taxation, right? After which it is like even the first 1/3 portion is partially taxable, and whatever is the remaining that you take as annuity is taxed like any income, right? Policyholders, you like when it comes to like because it's on a gross roll-up basis, the policyholders are not taxed on investment earnings as such, right? Does that make sense, guys? Yeah.
Could you repeat the last part?
So what I'm saying is, because it's like the investment returns are rolled up on a gross basis, the policyholders are not taxed on investment earnings as such, right? On the accumulation of investment earnings.
Okay.
Yeah. Cool. Now, South Africa has a very interesting approach when it comes to company taxation, corporate taxation. What they have done is they've divided the companies into something called a 5-fund approach. Okay. So in the UK, you have two categories, BLAGAB and non-BLAGAB. In the South African country, in the country of South Africa, they have divided it into 5 categories, and each of these 5 categories have different tax treatments. First is the individual policyholder fund, which has your savings business and historic protection business. Then you have the company policyholder fund, that are your corporate policies, group policies. Okay. Then is your untaxed policyholder fund, which is annuities, right? Which are owned by retirement funds. Then you have a risk policy fund, which has more recent protection business. And then you have something called a corporate fund, which is everything else, right? Now, again, you have a different rule for each of them. We are not how each of these funds work, like what is the exact taxation like analysis, like what is the exact taxation manner of every fund, that is not a part of a syllabus as such. Okay. When it comes to Australia, you're classifying
Sorry,
business.
can you go up? I think I just have one question. So
Yeah.
here in USA, are we saying that there is a tax, there's no tax on premiums, is it? And then
There is a tax on premiums.
this is an excess of premiums taxes.
Oh, that is when
And the
you're getting the benefit.
excess. Right. So here, I think you mentioned that premiums, like you can just pay here, it will be tax free. But on the right side, South Africa, premiums are taxable, right? Because it says
Where?
no tax relief on no tax
Oh,
relief
that
on
is
premiums.
okay. So we are talking about contributions here. Okay. When we are talking about no tax relief on premiums, we are saying so whenever you're paying premiums, that is out of your post-tax earnings. Okay.
Okay. So
Yeah.
even both, like US and South Africa, both will have
Both,
like
both of
same
them.
thing, right? Like you pay
Yes,
after post-tax
yes, yes,
premiums.
yes.
But the benefits in US has tax relief, and on the right side has
No,
no
both are
tax.
taxed. Both are taxed. It depends on the kind of business. For South Africa, first of all, they have not talked a lot about what is tax, what is not tax. They have talked only about US. Okay. So in the
Okay.
US, you like usually for your death benefit is tax free. Okay. But for things like surrender benefit, maturity benefit, right? They are taxed as income. And the taxable amount is usually the maturity benefit minus sum of premiums.
Right. But on South Africa side, they didn't talk about it at all.
They didn't talk about it because they have different sorts of funds. Every fund has a different taxation approach, so they didn't get into the complication of explaining each of them.
But that fund approach is in corporate tax, right? Or are you saying even personal tax that remains? I thought
Like
company
even
at the start implies that, okay, this company operates this kind of fund. So
no, no, no,
that,
no, no.
or,
Within the company, you can have different funds.
okay.
Okay, so you will every company will have a corporate fund, risk policy fund, company policyholder fund, individual policyholder fund. Each of them will get taxed in a different way.
Okay.
Yep.
Understand.
Okay. Moving on to Australia, you're splitting it into three parts. You're splitting it into protection, savings, and pensions business. Okay. What they have done is like remember we talked about uh, company taxation being comparable across different sectors. So they tax protection business like general insurance. They tax saving business like investment companies. Okay. And they tax pension business to say the pensions of any corporate entities, right? So corporate entities also maintain their pension pots, right? So similar to that, they have split it into these three types, and to maintain alignment as to how other industries are being taxed, they also impose taxes here as well. Okay. When it comes to policyholder taxation, uh, your your pension contributions, there's usually made out of your pre-tax income, so there's a tax relief available there for pension contributions. Your investment earnings, however, are taxed, but your benefits can be taken tax free. So that's something that's different in Australia as compared to UK as well as in US, right? Here, your investment earnings are taxed, but your benefits are tax free. Okay. For non-pension products, premiums usually do not get any benefits. So you're paying premiums out of post-tax earnings, and there's no tax on death benefits. Okay. When it comes to China, you have a gross roll-up of benefits. You do not have any tax relief on premiums, and your benefits are not taxable as well. However, there's something called VAT. So you have something called a value-added tax, which is payable on premiums for short-term policies, which is I think 6% of some, right? And there's also premium tax rate, which is 5% for insurance companies. Okay.
This one tax relief on premiums, and then sorry, for Australia it says investment earnings tax, benefits tax free above certain age.
Right.
It's kind
That
of
is for
like
pension products.
yeah. So investment earnings tax is basically, then how can these two things happen same, right? Investment earning tax, but benefits are tax free because benefits are
That
like
means
because of the investment
that means
earnings,
when
right?
they're taxed, it is on an I minus E basis. But when they get the maturity benefits, say the pension, actual pensions, they are tax free.
Oh, okay, okay.
Okay.
Okay,
Right?
okay. So basically, the
Again,
policyholder, it's like I
Mhm.
minus E is shareholder profit plus policyholder profit. So they tax it at a basic rate, PP,
Correct.
policyholder profit. But then they don't ask for any other marginal tax rate from
Exactly.
policyholders.
On the final benefits, on the pensions.
Okay, okay, interesting. Okay. Okay.
Again, I have not seen a lot of questions in the past around like what happens in Australia, what happens in the US. They will like we all you need to know is like what is the logic of such tax calculations, right? They may ask you case study based questions. They may give you a case as to some country is uh, taxing in this manner, so you may need to justify it, right? But they don't ask you questions as to what happens in Australia, what happens in the US, what happens in China. However, they do ask you questions around BLAGAB and non-BLAGAB at times. They are rare, but they do ask you questions. They have simplified the tax structure a lot. So I would not rely on questions before 2021 when it passed questions related to 2021 because the UK taxation for life insurance has changed a lot since then. In 2021, they made some changes to the tax code, to the material as well, that has simplified a lot of things when it comes to taxation. So, like any questions before 2021, year 2021 is not really reliable for us to practice, but you can practice questions 2022 onwards. Okay. Cool. Perfect. I know I've overshot on time today, right? So I'll close for now. Right. We'll continue with what? We'll continue with solvency requirements. So we'll start with solvency 2, which is again a very interesting, full of concepts topic. The next class, the next weekend that we have. Right. See you all next week. Thank you, everyone. Bye bye.
Thank you. Bye.
Thank you.